Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and with me, as always, is Bill Keen and Matt Wilson. Gentlemen, how are you?
We are doing great here, Steve. How's it going out in your neck of the woods, sir?
Pretty good. Got a bit of a cold here, so a little bit of congestion going on, so probably not my normal, smooth, silky audio voice today, but I think we'll get by.
Well, hey, I'm sorry to hear that.
Yeah.
Get well soon, but you stay in such good shape that that can't hurt, right? You're in great physical condition. I think you take good care of yourself. So,
Well, I try, and I'm actually trying to double down even a little bit more on the diet side, the food side. And just I tend to like sweets, and so I'm going to try and cut a little more of the sweets out of the diet and just see what that does for me. So we'll see how that goes.
all right. Well, they say drink lots of fluids, and my oldest daughter Taylor is a doctor, Dr. Keen, family practice physician. Very proud of her and the work she's doing. She gets a lot of accolades for her bedside manner, which is just awesome, and of course her technical prowess and capabilities as well. But she always tells me, Dad, just drink lots of water and get your 8 hours and stay active. You don't need to be a bodybuilder or a power lifter or go set any world records out there. Just know your age. And I'm speaking to myself now, Steve, at 56. This is my daughter's advice to her father.
Yeah.
So some of that core I said, well, what would be better? Would it be better to get a good night's rest or get up early and so I could get my workout in? And she said, every time the sleep is more important than the workout. We got off on that. Hey, living life to the fullest and being able to enjoy our resources includes being in good health as much as we can. So
that's right. Well, we want people to be financially fit. So
that is correct. And be able to enjoy that financial fitness. So
that's right. That's right. Great. All right. So what we're going to talk about today, we have a few questions that have come in from the listeners, and as well as you guys did a recent market commentary update, and I think some questions came in from that as well. So we'll go through those. But before we get to that, I think you guys did some things here recently on the charitable side, and I know that's an important aspect of Keen Wealth Advisors. And so what'd you have going on the charitable philanthropy side here?
Yeah, so we've shared, I say a little bit, maybe more than a little bit on our program here. And I know we certainly do at our events that we hold throughout the year, our live events, and through our social media channels, and even sometimes through our blogs here as well, and show notes when we talk about them on the program. But one of the things that we do at Keen, because we really feel like as a firm, Matt and I and the leadership of the firm and my wife, Carissa, we want that spirit of generosity to be a core value of our firm, or one of the values, at least, that support the firm. And so we've got something that we call the Keen Wealth Foundation. And that Keen Wealth Foundation provides resources to charitable organizations that we determine as a firm to support. So there's a Community Impact Committee, where we have committee members come off and on. They're team members of Keen Wealth that are honored to be selected for that committee, headed up by my wife, Carissa. And they're just doing some tremendous work leading the cause and the effort. Each year, we've now voted as a firm and ranked certain charities. And this year, our Impact Partner of the Year, a lot of you might remember, many of you viewers and listeners, let us know you saw Carissa on the news all of the month of March here in Kansas City on KMBC 9, talking about and promoting and representing Happy Bottoms, which was our Impact Partner of the Year last year. and we say Impact Partner of the Year. That doesn't mean that that's the only organization we support. We support many charities, but we do choose one that we call our Partner of the Year to really bring awareness and lean into and get to know them and work alongside them just in a deep way. And so this year, the firm voted on a charitable organization called the Farmers House, and they were in on Friday here just a few days ago, and they provided lunch for us and came and they addressed our entire firm. And the Farmers House is just a super impactful organization here in the Kansas City area, empowering youth and adults with developmental disabilities to pursue their best lives is kind of their mission statement. So they've got all kinds of different programs that cultivate job readiness and self-sufficiency skills, community inclusion, and successful employment, and all kinds of different things that they're able to roll out these programs for folks that are involved. And I think it was super impactful to see all those the organization and the way they presented to us. And the lunch, I have to say, Matt, was probably one of the better, if not the best lunches that we had ever served at Keen Wealth. Wouldn't you say, Matt?
Yeah, it was good. One of the things that they do is they sell goods at these farmers markets. There's several of them that they participate in, and they also have a catering division. Mm-hmm. And so we had them cater lunch, and it was very good.
So you missed it, Steve. That's one of the things about being out west. So, I mean, we could always send you something, but might not travel quite as well. But so that was amazing, and it's this early work experience in employment services. With these participants, a lot of folks ask, well, who is actually benefiting from this? Who are they call them the farmers, like the folks that are working inside of this organization and benefiting from these programs. But typically it's folks that are on the autism spectrum or Down syndrome or cerebral palsy or other developmental or intellectual conditions that are able to really, really lean in and benefit from these programs. And man, it's just going to be a really fun year because we're going to be supporting their big event in the fall as the primary sponsor to that. And I think we've got 7 or 8 volunteer opportunities or activities that Keen's going to be leaning into over the course of the year as well, helping them promote. And then in addition to that, we're going to, for those of you that are local here in Kansas City that are coming to our big barbecue coming up in a couple weeks on May 21st, they are actually going to be on site along with, I believe, the Veterans Community Project will be here again and some of the other charities we support, but they'll be on site. And we've negotiated with them or contracted with them to buy everyone some of their goodies to pass out to all of our attendees there on site at our big barbecue May 21st. So if you're here for that, great. If you're not signed up yet, get on our site there and you can enter your credentials and you can come be a guest there as well.
Well, that sounds terrific. And boy, it makes me want to jump on a plane and get to Kansas City.
Yes. Yeah. And then Steve, Saturday morning, it was an interesting weekend because then Saturday morning I had my quarterly Angel Flight board meeting. And that is, we've talked about Angel Flight a lot. We fly sick patients all over the country, all over the Midwest. And then we work with other places like Angel Flight Central if someone needs to go out of our 14-state region. But we fly folks that need medical treatment that otherwise would not get to their medical treatment where they need to go, and we do it 100% for free. There's about 330 volunteer pilots. I'm one of those volunteer pilots, but also a board member and treasurer, the executive committee there of Angel Flight Central. And so I had that board meeting Saturday morning. So following the Friday of Farmers House being here. And then that very same day on Saturday night, Matt and I had the privilege of attending with several guests, our wives and several guests, the Boys and Girls Club of Kansas City big gala on Saturday night, which we also support as well as one of the sponsors and supporters of that organization. And the work that the Boys and Girls Clubs are doing around the Kansas City region and around the country is pretty phenomenal as well. They actually had 1,600 people in attendance. And they raised $3.3 million, over $3.3 million net at that one event. So it was an incredible rally of support from the community to support the kids that are affected and positively by the Boys and Girls Club as well. So it was really like it's been a great few days this last week or so, seeing some of the wonderful generosity that not only our team at Keen is pouring out, but also just the community at large. So you watch the news, you see a lot of negative things, but there's a lot of good things going on as well. So
yeah, and so many good things happening at the local level. And oftentimes that's what it takes, is the grassroots at the local level to have this kind of impact. And what I also really like about what you guys are doing is you guys could have done a top-down thing and said, hey, these are the charities that the company's going to support, and we'd like you all to do this or that or the other thing. But you reversed it and you left it up to your team to decide who does the team want to support. And so now it's their decision, and they're the ones who are really excited about it. They've picked organizations that they're very excited about and want to make an impact with. And so I think that's great that you've allowed your team to come up with this, as opposed to you guys just saying, hey, we're going to do this organization. So
yeah, thanks for recognizing that, Steve, because for us, that was really truly why we formed that committee and why we wanted to do it that way. And I got to tell you, the team, when we're thinking about different charities to support, a lot that goes into it is, how can we get on the ground in the trenches, boots on the ground, as they say. Oh yes, the financial support's important, but how can we also get out in the communities and work shoulder to shoulder with these folks, making a difference as well? Because I think I just think it's meaningful and it's impactful. And we want to encourage other firms. I know we have a lot of advisors that listen to our show, watch our show, financial advisors, to get out there and do the same thing too. So if we can inspire others to step up and do that as well. I know a lot of folks are already, but I think that's another aspect to it. It's all kind of all very positive.
It certainly is. All right. Well, let's jump into a few questions that have come our way, and we're going to jump right into the deep end here with the first question.
And again, Steve, remember, Matt just did his quarterly market outlook, and we're going through a time where, we've got the tariffs and there's been some volatility, although not as bad as the news might make you want to think it is, but yet certain sectors are and different things. So Matt just did his quarterly update, which was highly attended via webinar. And so these were questions that came in from that he committed to answering on there as time ran out with the program there. So with his webinar. Yeah.
And as it relates to the tariffs, China, of course, is one of the main recipients of the tariffs. And so one of the questions that came in here was related to China. And the question was essentially, is there any truth to rumors that China might dump its holdings of U.S. Treasury securities? And so, Matt, maybe you could give us a little bit of history and context in terms of China owning U.S. Treasury securities, and what does it look like historically, and where are we today? Are they reducing their holdings? Why do they hold U.S. Treasury securities? Is that a good thing? Is that a bad thing?
Yeah, I know, because it's like, okay, well, why does that even matter if China owns our government bonds? Because that's what treasuries are, and ultimately, it matters if they were to suddenly and unexpectedly decide to liquidate all of them. So they would go into the marketplace and just start selling them, which would inadvertently raise yields on government treasuries, because there'd be a big seller out there just kind of getting rid of them, and it would lower the price potentially and increase yields. Anytime that there are geopolitical issues or tensions, this always comes up, and really it seems like it's just been for the better part of 10 years or longer, conversation about China and being the largest holder of U.S. bonds and wanting to get rid of them. Well, they have been selling them, but they have been doing it since 2015, and it's been a pretty orderly reduction of U.S. treasuries. And actually, China is not the largest foreign holder of treasuries anymore. It is now Japan. And so, again, less and less of an impact there. I would not expect to just see them dump it on the market, as our listeners kind of asking. And it's because, it would hurt their ability to get out of them at the value that they're worth, because they'd have to sell them at a discount, most likely, if they were trying to kind of fire sale them. And then two, there's other ramifications, because it's like, well, why do they even have these treasuries in the first place? And
Right.
the reason is because, well, we purchase goods in the U.S. from China, and we pay China in U.S. dollars. So instead of just exchanging that back into their own currency, which they could do, but there's a cost to do that, and there's purposes for them to hold U.S. dollars. Well, instead of just sitting in dollars, they purchase U.S. treasuries with those dollars. And the reason they purchase U.S. treasuries is because, well, one, it's the most liquid financial market in the world. More U.S. treasuries trade than anything else. They're considered safe because they're backed by the full faith and credit of the U.S. government, and they pay interest. So, instead of just holding dollars that do nothing, you earn some interest on that. So that's why they would own treasuries to begin with. And if they were to just suddenly, dump them on the market, it would actually hurt their currency, because their currency, the yuan, is pegged to the dollar. And if they were to suddenly make the yuan more stronger relative to the US dollar, then that would make their goods more expensive here in the US, which is not what they'd want to do. They'd rather have a weaker currency, a weaker yuan, than relative to the dollar, because that makes their goods cheaper and more competitive. So a lot of nuance to that, but again, it has been happening, and it's not necessarily something that I would say is just a surprise that they're doing. It's just more orderly. They're just purposely reducing their holdings, but they've been doing that for going on a decade now.
Yeah, just to throw some numbers out here, in the 2010s, China's holdings of U.S. government bonds reached around $1.3 trillion. And now it's down to, I think, just under 800 billion. So they've cut about $500 billion of their ownership of U.S. government bonds. And it seems to have been fairly orderly. And during that time, we've seen really low interest rates. We've seen interest rates go up. So it seems like it hasn't had a huge impact. The U.S. dollar in recent years has been strong. It's still strong, although it's come down here in the past few months. But it seems like it's been fairly orderly. So yeah, to your point, unless China were to just quickly dump, which seems unlikely, because that would also have negative consequences for them, but wouldn't be surprised to see them continue to sell off some in an orderly way. Yep, good. All right. Another question that we have here is from John, and this is about dividend payouts, and just wondering that with what's going on with the stock market and with the economy, what may happen with the economy, should we expect companies to start reducing their dividends?
That's a common concern, especially when stock prices go down. The dividend yield, it's just what's the dollar amount that the company pays on a dividend as a percentage of the stock price. Those go up. And that can be very attractive to investors with funds available, or if they have it in different asset classes and they rebalance, and picking up, good solid companies that have some good dividend yields relative to, to what you would get on bonds and other things. If we have a long sustained pullback or recession, I'd actually kind of lean it more towards a recession than anything else. It's possible. I mean, we have seen that in the past, where dividend just across the board, it's not every single company, because they're all structured differently. But if you look at a broad benchmark like the S&P 500, during 2008, 2009, the dividend that was paid as a percentage of all the S&P 500 companies was reduced for a couple of years, and then it slowly went back up, and it's higher than it's ever been. And that's one thing with dividends, is that a diversified portfolio of dividend paying securities, I mean, typically you're going to expect to receive more each year. And if that diversified portfolio, when you do have, I say long sustained pullbacks, that's more likely to see that. But in this more run-of-the-mill volatility, don't think that's a huge risk at this point.
And as Matt mentioned there, dividends, typically there are some stocks that don't pay dividends. When we discern between what we call generally a growth stock, like maybe a newer company that's getting started and they're taking all the profits that they're making in their company and they're investing it back in. So they're not at a point in their life cycle yet to say, hey, we need to take some of these profits and pay them out to our shareholders. Typically companies pay a quarterly dividend. Others do not, but there's two ways to make money to increase your wealth in owning securities or companies or stocks, and that's one, the price. Hopefully you buy it and the price goes higher, which is a capital appreciation, and the other is you get paid along the way on companies that do indeed pay dividends. And I think it's important to mention too, Matt, when we talk about it, that the way to analyze these companies and looking at some of the things that we believe are important about their coverage ratios, what their free cash flow is to the dividend they're paying, not being an investor out there uninformed and just going and looking at the companies that pay the highest dividends thinking, oh, I'm going to find the one that pays the highest. Those would be the most likely to be ones that would be cut in a downturn, or some of these highly leveraged real estate investments we've seen people present to us, referred over, where they were sold these investments that had these super high dividend yields, but nobody had the salesperson that were promoting that didn't really look at the underlying strength of the company, and it was short order before they couldn't cover those dividends anymore. And and when a company cuts a dividend such as that, then all of a sudden the value of the stock, now you got dividends being cut and the price being cut. So it's important to have a process for understanding which companies, because it makes all the difference in the world. You can't just say, will dividends be cut? Well, you can, and Matt did a great job answering it, but there's all kinds of different companies, different structures, different industries, different sectors to be aware of, and to really be discerning about how you select which companies to buy. And it's not just the one with the highest dividend at the moment.
Yep, well said. All right. Another question we've got here is, when markets decline, is that a good time to do a Roth conversion where you take money from your traditional IRA, individual retirement account, convert it to a Roth, pay some taxes on it, and then you have some tax benefits with the Roth IRA going forward? So is that a good strategy to think about?
Yeah. All things being equal. So let's just, throw that caveat out there. If you were going to convert money, that was part of your plan, convert money to a Roth IRA, doing it when prices are lower can be a good thing. I mean, it depends on what you're going to invest in. I mean, if you're just taking it out of money market and putting it in money market, well, that's not going to make any difference of the timing. But if you let's say you own stocks in your IRA, you can actually move shares over to the Roth IRA, so you wouldn't even have to sell anything. Now, you can coordinate a buy-sell strategy to where you sold and bought almost essentially the same day. So it's not like you're really at risk of being out of the market. Settlement periods now are 1 day. I mean, things have really changed over the last several years, where when you sold, you had to wait 3 days before you could transfer money. Well, that doesn't exist anymore. It's much, much slower. But converting, if you think about it, just converting shares, because if you have 100 shares and it was worth $100,000 and now it's worth $80,000, but you move that 100 shares over, well, you're only paying tax on the $80,000 now instead of the 100, with the hopes that it's going to go back up to $100,000. And now that's a free gain, so to speak. So that's definitely a strategy that we look at during market pullbacks.
Smart and prudent way to harness some of the cycles that are out there, and not just feel that you're at the whim of the short-term volatility. We always say, don't we, Matt, like that we want to harness the cycles, not be whipsawed by the cycles, so that there are some very proactive things to do in all markets, in all conditions. For sure.
Yeah. And every investor situation is unique. And so a Roth conversion strategy might be appropriate for one client, may not be appropriate for another client. It really depends on their situation, embedded gains, and what
That's
the
right.
projected future is going to look like, and a lot of different variables. And so that's why it really makes sense to work with a professional who can ask all the right questions and make some good assumptions and analyses to figure out what makes the most sense. So appreciate that. All right, another one here. This is a good one. I get a similar question from my dad, which is like, who is the market? Who is
Yeah.
or who are these people that are doing all this trading out there? Who's moving the market? So Alan is asking, who is doing all this trading? Is it individuals? Is it funds? Who else is it? So who is, quote,
Sure.
the market and is moving all these things?
Well, the answer is all of the above. I mean, it's
Okay.
people, it's professional investors, if you like want to say that. Those are institutions. Some of it is pre-scheduled, where institutions, if they have a process that they buy or sell on certain days or around certain time of the month. This is if you're paying attention to financial media, you'll come across this where they talk about towards the end of the quarter where funds and or institutions have to rebalance holdings. And they can kind of, people know, well, because a lot of that they have to publicize as part of their process, as part of the prospectus, is how do they do that? So you can do the analysis and determine, well, this is how much they're going to have to sell of their bonds to buy stocks, or vice versa, based on this, this formula that they've published. And, there's enough volume there. You can't really, I would say, take advantage of it, but that is a comment that gets made towards the end of quarters around these rebalances that have to happen. So that's like a pre-scheduled thing that's automatic. Then you have just individuals, which can be a lot of it, that just react, probably reacting at the wrong time, taking a emotional kind of making an emotional decision. And, they might be selling shares of mutual funds they own, which then in turn means the institution that is managing that fund has to then do something, typically sell their underlying investments to free up the cash to redeem those shares. So it's a combination of everybody, but yeah, because you would think it's like, well, why would they be selling? Why would they be doing this? I'm sure that's what your dad's probably like. This is, nothing's really changed. What's going on? And it's like, well, people think that something is happening and they need to react to it, and then that's what that domino effect happens.
Yeah, and there's all that academic research that would suggest that the markets are fairly efficient in assimilating information and responding to new information as it comes out. And we do see sometimes, whether it's a tweet from the president or the Federal Reserve raises or lowers interest rates, or some other thing happens out there while the markets are open, and within an instant, the market goes way up or the market goes way down. And I can't imagine it's like individual investors that are sitting there with their finger to make a trade. Is that really more just all these computerized trading algorithms from the high frequency traders that have stuff all programmed in there that if we hear this word that comes across the wire, then we're going to do this? Or how much of that stuff is like just these computer trading people out there in hedge funds?
Well, and that's hard to determine. And it's because almost all trades are routed through some different type of computer system. So, if an individual is just trading themselves on a brokerage platform, it's getting sent to an exchange through some sort of, computerized system. So when they say, well, most trading is now computers, it's like, well, yeah, it's just because that's the nature. You're not calling them in and someone's not writing it up and then, calling down to the trading desk and then they're calling it in somewhere else. I mean, it's just not how things work anymore. When you see, things like that, that would be more the institutions that are trading, and then people then start to react to it. So it's like all of a sudden common when, when you said, Steve, whether it's the president says something or more likely you're going to see this during the Federal Reserve and the press releases that they have regarding their policy. So they have a meeting where they release, here's what we're doing, interest rates up, down, keeping them the same, whatever. And then they have another event where they discuss and take questions. And based on certain questions and answers to those questions, people, these institutions will react, and it could be positive or negative. And then you have these momentum kind of traders who they just tag along. They don't care the direction. They're just, oh, this is going up, so let's just kind of ride it for however long it takes till they decide to sell it. So, there's, again, it's kind of like, it's not like there's all these people doing it. It doesn't take much sometimes. I mean, it's all relative to, to what the volume is and everything else.
I think you all might remember, now I'm going back a few years now, but we had one of our guests on the program, Joe Ratterman. It was probably, oh my goodness, 5 years ago. And we might want to link to that in the show notes here. Joe was the CEO of a company here in Kansas City called BATS, Better Alternative Trading System, and he talked a little bit about how the orderly liquidity, the nature of our markets, the most orderly and the most liquid markets in the world are right here in the United States, and the most fair markets as well. And they'd founded a company, the founder of that company, Dave Cummings, who I actually went to high school with, same graduating class. And then Joe, who was the CEO. It's a wonderful story right out of Kansas City. But one of the firms that created a trading mechanism that helped to further make things more efficient, so that the individual investor it's not like a smoky room on Wall Street with people behind the curtain trading with these large bid-ask spreads. It's a very, very efficient computerized environment right now in the United States. So that'd be interesting to go back. If we could probably do a show, have Joe back on, although he's extremely technical. And he's very, very smart. So maybe we do another show for just the folks that want to go that technical.
Yep.
But it's interesting too, because why are we talking about this? Well, we're talking about it because nearly every client that we serve, and all of us here on the show right now, you Steve and Matt, we have some of our investments in securities, in liquid tradable securities in the capital markets, in stocks and bonds and ETFs and things of that nature. And so we're participants in these markets. So we see the daily moves, which is really as you mentioned, that efficient market theory, which I think is true. It says the market will always discount future cash flows back to this very moment and try to make an assessment of what things are worth based on the information that it has available that's public. We're all participants in that, but there's a very different experience if you're a long-term investor or if you're a day trader or a speculator. It's the same investment pool, but it's a very, very different experience and a very different strategy and a very different way to be prepared, to be proactive, to not be reactive, to be intentional about how things are aligned and allocated so that you can sleep at night. And you don't have to look at these daily swings as something that affects your long-term planning and success.
Well, speaking of that, Bill, I think that's a good lead into the next question, which comes from Doreen, and she's asking about what is your strategy to take advantage of market volatility? And given you're generally longer term investors and clients are investing for the longer term, what do you make of the volatility? And just to put this in context, as we're having our conversation today, year to date, 2025, the S&P 500 is down approximately 7%, maybe 8%. Year to date, and then from its high earlier this year, I think it's down maybe 11%. Those are very common fluctuations in the market over any given period of time. So it's not like we've had we've had volatility, big up days and big down days, but when you look at the net of everything, we haven't had big moves year to date, net. So does this kind of movement affect how you think about investing right now?
Well, so there's things that we look at, and volatility is something we pay close attention to. So that is, that's price movements higher or lower. I mean, volatility goes both ways, not just to the downside. But, Donald already asked the question about converting money to a Roth IRA. I mean, that's one way to take advantage of it, to take advantage of lower prices, especially when it's like, hey, you have a long-term strategy to move money into this Roth IRA. If we could move some at an opportune time, great. Let's use that to our advantage. Other avenues are just rebalancing the portfolio. And we take a volatility-based approach to where we we have guardrails under, within all the portfolios, and we look at if something's outside of its guardrail, do we rebalance some of it, take a small piece of the profit out of something that's performed well or something that's up, and then take that profit. So you're not selling all of it and then just moving all of it somewhere else. You're just taking little pieces of it and redeploying that into something that's gone down in price with the expectation that it's going to come back. It's that's really the theory behind it. I mean, if we didn't think something that went down in value was going to come back, we would sell it and redeploy that capital somewhere else.
Right.
So that is the tried and true way of taking advantage of volatility, is just rebalancing. And that's not overly complex or overly sexy. Sometimes people think that there should just be all these moves, and you're looking at this and now you're day trading now, and it's like, no, that's not going to happen, because one, day trading is I think a loser's game. I mean, it's just not a profitable way to invest. I mean, if you have a lot of comparisons to gambling with the stock market at times. And when you're day trading, yes, those comparisons make a lot of sense. But when you're a long-term investor, there is no long-term gambling strategy. It's the house wins. That's long-term is what happens. In investing, the longer you're invested, the higher the return you should expect. And the odds of a positive return increase exponentially the longer that you're invested. So it's like you're paid to sit and wait. It's just, you got to have a strategy to understand, and a plan too. It's like, well, what does that mean? What is this? Okay, markets are down. The stocks are down from the peak 10, 11%. As you pointed out, Steve, any given year, we can go back to the early 80s. And I share this data during the webinars that we could expect 14% peak to trough in any given year, because on average, that's what happens. So it's like, this is all within the norm. You see those 5% up days, that kind of, okay, is there something going on? Well, that can indicate that there was probably some investment vehicle that maybe blew up, some sort of thing that just kind of went the wrong direction. And that can happen to these leveraged institutions that are executing on one type of strategy. A lot of times you hear about it after the fact, months later. It's like, oh yeah, what caused that volatility? It's because no one was expecting this to happen, and all of a sudden it did, and it just kind of blew a trade up. And that's what that volatility took a few weeks to work its way out of the system, and then things go back to normal. So, that's something we pay very close attention to.
Yeah, and I think related to that, we've got a question here from Michael, and he's wondering, he's a senior, and
Sure.
he's wondering if he should sell some stocks to avoid further loss here.
Sure.
So maybe talk about like what your time horizon is.
That's right.
As an investor. Talk about how much have you set aside already as part of your financial plan to take into account situations like we're running into right now. So it's, you guys plan for all of this.
That's right. Yeah. Like in Michael's situation, if he was, live with us, I would ask, well, how old he was, and income and distribution needs and things like that, because that's what really makes how much you should own in stocks versus bonds. We back into it based on information, not just, well, you own stocks just because they go up, over long periods of time. It's like, well, if you're going to need to spend some of this money over the next 5 years, well, that should be invested differently than money that you're not going to spend for 5, 10, 15 years in the future. Now, based on Michael's age, I mean, if he's, he may not have that long in terms of what he thinks his life expectancy is going to be. So that would definitely come into consideration. But, we have clients, as they age, they start to realize too, this isn't the case for everybody, but for some of our clients, that this money, they're not even going to touch. It's actually for their beneficiaries. And then they start thinking about that differently. Oh, well, if this is for my kids who are in their 30s and 40s, well, that can be invested as if they own the money right now, because it's just going to transfer to them if I'm truly don't need it. And we help people think through that, because it's like, it's all, what's the purpose of the money? If Michael wasn't living on it, I mean, we could make the case you should just own, all stocks, but the best investment strategy is the one you can stick to. So if you can't handle it, that's also a recipe for disaster. It's not just about what does the best. It's the one that works for you. And some people are aware of that, and they're able to know like, hey, this seeing price movements up and down, just they can't handle, and they want to be ultra conservative, and nothing wrong with that. Everyone's different.
Well, I think we'll wrap it up there. Some great questions here from our listeners and from folks that participated in the recent webinar. And Bill, any final comments here as we close the show today?
Well, just to reiterate, I think we had some great questions, some great engagement, again, with Matt's quarterly market outlook webinars. So if you haven't seen that, and I always recommend viewing that. So because he does have a lot of charts from the Fed and some other places that are, it's way easier to look at while you listen at those charts. So you can go to our website and you can watch that right there to catch up with that. But then the questions that come in that we're able to answer as a result of that, like we've done today, I just always want to bring it back to these questions have to be looked at, every question, not just these, in the context of your overall financial plan. We have to know, but really more importantly, each individual investor has to know what is the purpose of their investments, what's the direction of the resources that they're stewarding, that they're managing. And once you figure that out, then you can, as Matt said, reverse engineer an allocation that will serve you. And we know very much up front that we're going to go through booms in the market. There's going to be downturns in the market. Certain sectors will do well at certain times. Other sectors will rotate into favor, and others will rotate out of favor. None of this is a surprise. It's something that we know if we can put a strategy in place, understanding what the objective is with the resources, understanding when someone needs the money back, how much they're living on, what their charitable inclinations are, what Social Security strategy makes sense from a Medicare or medical health care standpoint, what makes sense there as well, considering life expectancies, next generations. Are you in a sandwich generation where you're caring for your elderly parents and your kids, possibly grandkids? So many different things that all come together to and it's really fascinating and fun for us and our team to see each individual, really piece of art almost, I would put it, each individual's financial plan come together where all those things get some clarity around the direction, and then to be able to build a plan where we pay the least amount of taxes possible and affect this in a way that folks can live their life with intention and excitement and passion in the second half of life, and have the investments simply be that engine to the plan, that makes it all possible. And then to have a little left at the end if you choose to leave to the next generation or charities of your choice or some combination thereof. It's a pretty fun journey. So I love that we were able to tie some of this together for Matt's quarterly webinar, and I appreciate both you guys. You guys are both seasoned pros, and it's you make it easy on me to do this show with you. So here's to many more years to come.
All right. Appreciate that, Bill and Matt. And as always, if you'd like to get all the details for this episode, please visit us at keenwealthadvisors.com. We have a section there in the menu where you can get access to all the blog posts and all the show notes from the podcast that we're doing here. And then if you have not subscribed to the show yet, please do. Please also check out the Keen Wealth Advisors YouTube channel where you can watch the video, not of the podcast, but of things like the quarterly market updates that you do. We've got some good videos out there. And also tell all your friends about the show. We'd love for your friends to also participate and subscribe. So we're all about trying to continue to make more people financially literate. So we appreciate that. All right, guys, thanks again. And we'll catch you on the next episode of Keen on Retirement.
All right. Thank you.
Mm-hmm.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. this program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.